Mutual fund investments in India are booming. The total investment amount and the number of investors are skyrocketing, making mutual funds one of the most popular wealth building tools. But how can new investors navigate this landscape and maximize their returns? The key lies in understanding the right strategies to make informed and profitable investment decisions. Let's dive into the video. Hi, welcome to holisticinvestment.in, where we simplify the world of personal finance for individual investors like you. In recent years, mutual funds have gained immense popularity in India. In February 2025 alone, 25,999 crores was invested through SIPs, which is systematic investment plan. Over the past year, 73 lakh new investors entered the market, a 19.3% increase. But why are so many people choosing mutual funds? First, flexibility. You can invest any amount anytime. Number 2, accessibility. Start with as little as 100 rupees. And number 3, wealth creation. Potential for higher returns over time. However, past returns alone shouldn't be the reason to invest. New investors need a structured strategy to maximize gains and minimize risk. So, SIPs are one of the biggest reasons for the mutual fund boom. They allow investors to start small and grow over time. Why are SIPs so powerful? First, flexibility. You can increase, decrease, or pause investments anytime. Number 2, disciplined investing. You can automate your savings and build wealth over time. And number 3, rupee cost averaging. You can invest regularly, lowering the impact of market volatility. So, wouldn't it be easier to build wealth if your investments worked on autopilot while benefiting from market fluctuations? That's exactly what SIPs do. So, first, why does financial goals matter? Just like a journey needs a destination, an investment needs a clear financial goal. Ask yourself, are you saving for your child's education, buying a home, or early retirement? When will you need the money and how much should it grow by then? Without a financial goal, investors often make impulsive decisions like panic selling during market downturn. Worse, some enter high-risk funds without understanding the investment horizon, leading to avoidable losses. Wouldn't it be wiser to align your investments with long-term goals to stay on track and minimize risk? Number 2, setting realistic return expectations. Many new investors expect mutual funds to double their money overnight. But is that realistic? Let's set the right expectations based on historical returns of each fund type. For debt funds, the expected annual return is 7%. For conservative hybrid funds, the expected annual return is 9%. For multi-asset funds, the expected annual return is 10%. For aggressive hybrid funds, the expected annual return is 11%. And for equity-oriented funds, the expected annual return could be 13%. So, expecting 20% plus returns every year, that's unrealistic. Instead, view anything above the expected return as a bonus, not a guarantee. So, number 3 is diversifying across asset classes. Would you put all your eggs in one basket? Of course not. Then why put all your money into a single type of investment? A smart portfolio should be diversified across multiple asset classes such as equities for their high growth potential, debt instruments for stability and lower risk, and gold or silver as a hedge against inflation, and real estate for a long-term asset appreciation. For those who prefer a hands-off approach, multi-asset funds automatically balance investments across these asset classes, ensuring stability and growth without constant monitoring. Number 4 is balancing equity fund investments. Many young investors chase after high-risk mid-cap and small-cap funds, assuming they will always deliver higher returns. But is that always true? Equity investments are cyclical, meaning large-cap, mid-cap, and small-cap funds perform differently in different market conditions. The key is balance. Instead of manually picking separate large, mid, and small-cap funds, investors can opt for multi-cap funds which diversifies across all market caps. And flexi-cap funds gives fund managers flexibility to invest across categories. For lower risk investors, large-cap funds focusing on well-established companies offer a more stable investment option. So, wouldn't it be better to spread your investments strategically instead of relying on a single market segment? Number 5, role of debt funds in a portfolio. Should new investors avoid debt funds just because they offer lower returns? Absolutely not. Debt funds serve two critical purposes in a portfolio. First, meeting essential expenses, perfect for short-term goals like school fees, insurance premiums, or emergency needs. Number 2, taking advantage of market downturns. When markets drop, having funds in debt investments allows you to buy equity funds at a lower NAV, boosting long term returns. And a well balanced portfolio should always include a mix of equity and debt investments to ensure liquidity, stability, and growth. So, what is the final takeaway from this video? Mutual funds offer a great opportunity to build wealth, but only when approached strategically. By setting clear financial goals, having realistic return expectations, diversifying across asset classes, balancing equity investments wisely, and allocating funds to debt instruments for stability, new investors can maximize their potential returns while protecting their investments from market uncertainties. So, are you ready to take a well planned, informed step towards financial success with mutual funds? Then click the link in the description for a free consultation with one of our certified financial planner today. And if you find this video interesting, give it a like, share, and subscribe to our YouTube channel. I will see you in the next video with much more interesting financial insights. So, yeah, thank you for watching.
You can definitely check out the blog post we have posted on our website through the link in the description. And if you want to gain more professional guidance through a professional financial planner, you can choose to book a one-on-one complimentary consultation with one of our professional financial planner through the link in the description. Also, if you want to gain more investment and financial insights through the leading experts in the finance industry, we also conduct regularly free live webinars through which you can register and gain these insights. The link is in the description. Also, if you like this video, definitely hit like and subscribe to our YouTube channel so we can come up with more such financially beneficial content for you. Thank you for watching.